What is up, everyone? This is Warren Howe. Hope you're having a great day out there. For those of you that are celebrating, Happy Chinese New Year. Yep, Gong Xi Fa Cai. That translates to Hope You Get Rich. Yeah, words from Ronnie Chang. Anyway, so today we will be talking about liquidity. Yep, and how liquidity is king. How can we think like Warren Buffett? How can we think like bigger companies out there? So this is quite an action-packed video. Hope you enjoy it. If you haven't, right, show a brother some love. Smash that subscribe button. If you like this video, smash that like button. Yep. So let's get on to liquidity. Now, I want to walk us through memory lane yet again, right? And we can learn a lot of things actually from 2020. Yep. Massive liquidation that causes S&P 500 to drop 35%. Now I know these times are not as drastic, but it's sort of reminiscent of that. Yeah. But I want to be sharing what was my thought process before buying in distressed assets. Yeah. We don't simply buy on a dip. Let's put it that way. We don't simply buy on the dip because we have to assess. After all, these are companies. Yeah, these are companies distressed because of COVID, right? So I want to bring a very important sort of case study scenario on Carnival Cruise. Yep. So what was my thought process before buying Carnival Cruise Lines during 2020? Because Carnival Cruise Lines essentially zero revenues. Yep, zero revenues at that time. So what is the thought process in order for me to decide whether or not I want to risk my money in a falling down market in Carnival Cruise? So what I did was, okay, logically, I assessed their cash burn. Yep. The cash burn reported, and CNBC was actually doing the work for me, but I actually had to look at their balance sheet, look at 2019's balance sheet, right? Look at their performance, look at their indication, and also look at their liquidity. Now, first of all, the whole concept is very simple. We need to work out how much cash they can raise from all capital resources, either from funding, revolve credit facilities, the cash they have in the bank, yeah. And this can be extracted from the balance sheet, yeah, and basically their recent 10K or their 10Q, okay? But after assessing that, I need to work out how much cash they have to burn in order to maintain the business. Now, I consider CAPEX, I consider OPEX. Now, they can lay off staff, but essentially they can't lay off everyone. So CNBC sort of did the job for me and said, okay, their cash burn a month is close to 900 mil. That's more than all of their competitors. Yep. But why Carnival Cruise? Because I deem that their capital resources, I looked at their brand, right? So we still have to do homework, qualitative analysis on the whole company. But essentially, when it comes to liquidity, I worked out, okay, how much cash burn, right? 900 mil a month. Then I worked out their funding sources. So as at November 30th, 2019, we had liquidity of 12.5 billion. Our liquidity consisted of 182 million cash in the bank, 336 million of cash used for current operations, 2.8 billion available for borrowing under our revolving credit facility, and 9.5 under our committed future financings. So basically, with the assets that they have and raising money from the bank, they're able to borrow 9.5 billion. Altogether, they have 12.5. That is their liquidity. So if they were to burn 900 million a month, they could last for probably 1.5 years. Then after that, they raise their bonds and whatnot. So I don't want to be going down too detailed, but my thought process was simply, okay, the stock market is heavily oversold. They have credit facilities to work out actually, to have runway, right, for 1 year, 1 year and a half. I decided, right, let's take this is a decent reward over risk, simply because also their valuations are way oversold and very cheap. So before buying the dip, we need to realistically look whether or not these companies can survive. So, in 2020, the stock market was insane. After that huge rundown, it's a V-shaped recovery. I basically just 2 to 3x my money in Carnival Cruise just off the stock market. Now I sold because this is a stock that I'm not going to marry. This is a stock more of a thematic or momentum play, but that's that. But today, this is something that you can take home with. And also, when you want to relate back to our own portfolios, what is our liquidity? Think about it. The whole stock market is actually dropping. Yeah, we got NASDAQ dropping down, used to be from 15% from the highs, and now it's 8%, 9% from the highs. My point is, right now, the whole market, the Feds are actually paving a clearer path for us. They're trying to tell us, hey, we are raising interest rates, and knowing historically and logically, realistically, when interest rates go up, money flow tends to be in safer assets, riskier assets will get sold. They're already paving a way for us. That means we are expecting more gloomy days ahead. By doing that, we should being in a position of power to know, okay, what are the companies that will have huge runway regardless of their stock price, and they can benefit from just gaining. If we can work that out and assess our own personal liquidity, right? And I'm not trying to say borrow money to go in a stock market. I'm trying to say liquidity is king because we have decent cash amounts that we can actually deploy realistically and strategically, knowing that the market is actually going down further and further and further. Yep. So, and another perspective is that when the Nasdaq is actually going down, high growth companies are actually going down, Roblox is going down, what are the potential companies ripe for acquisition? We should think like Warren Buffett right now and be patient, because there are plenty of opportunities in the market, right? Like I said, the Feds is actually paving a way that's saying, okay, stock markets might go down this year. Highly probable that the markets are going down. So Warren Buffett, Google, Apple, cash-rich companies, they can potentially acquire other companies simply because their companies' valuations being traded in the market is actually going down, 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 cheaper, 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 right? Because they can be patient and say, right, instead of me buying $30 per share for your company, I can wait for it to go down $15 per share, and all they had to do was just wait 6 months, 8 months, 1 year. They just have to be patient. So my point is, assessing liquidity when it comes to companies, we should be reflective of assessing our own personal liquidity so that we can be grabbing, thinking like Warren Buffett, thinking like cash-rich companies, to be acquiring or buying a piece of that company when it's cheaper. So guys, again, liquidity is king. We will laugh all the way to the bank if we are patient, if we are liquid enough, and we have cash, knowing our cash portfolios, right? Our portfolio blueprint, and of course, knowing the runway for growth of this company and whether or not this company itself has liquidity and in order to survive bad times. Yep. So I hope you guys got some value out of this video. Smash that subscribe and smash that like if you like this video, and I'll see you in the next one. Thank you.